Hey traders, welcome to Trade Junction. Today, I'm going to break down one of the most powerful reversal patterns, the head and shoulders, using a real nifty trade from the 13th. If you love learning about price action, trading strategies, and real market breakdowns, make sure to subscribe to Trade Junction and turn on notifications so you never miss a profitable setup. Stick around to the end to learn how to spot, confirm, and profit from this setup like a pro. Let's dive right into the charts. Here's the Nifty 50 chart from the 13th. What do we see? The head and shoulders pattern is a bearish reversal formation that signals a potential trend change from bullish to bearish. It consists of three key parts: left shoulder, a rise followed by a pullback; ahead, a higher peak followed by a pullback; right shoulder, a lower high, showing weakness in buying momentum. Looking at the chart, we can clearly see the formation of this pattern. The buyers pushed the price up to form the left shoulder, then the market made a higher peak, the head, and finally the right shoulder formed with a lower peak. This was our first clue that the uptrend was weakening. The key to trading this pattern is the neckline. It's the support level connecting the lows between the shoulders. Once the price breaks below this neckline, it confirms the pattern and signals a potential downtrend. On the 13th, the neckline was broken with strong red candles, showing a high probability of further downside. This was the first signal for a trade setup. One of the most powerful confirmation signals is a retest of the neckline. After breaking the neckline, the price sometimes comes back up to test the previous support as resistance before continuing downward. And that's exactly what happened in this case. The price broke the neckline, then pulled back up to retest it. This was the perfect second entry opportunity for traders who missed the initial breakdown. Why is this retest important? It confirms the breakdown. If the price fails to move back above the neckline, it means sellers are in control. It gives a better entry for those who want extra confirmation. It allows for a tight stop-loss placement just above the neckline, improving the risk-to-reward ratio. After the retest, the price got rejected and continued its downtrend, providing a solid short trade opportunity. Now, how do we trade this setup for maximum profit? Entry. The trade can be either selling the index or buying a put option when the price closes below the neckline with high volume or on the retest rejection. Place stop loss just above the right shoulder or the neckline retest zone. Measure the height from the head to the neckline and project the same distance downward as target. In this case, once the price broke the neckline and retested it, it dropped significantly, giving traders a high reward-to-risk ratio. Those who shorted the index or bought a put option would have made solid profits. To increase confidence in this setup, we can look for volume spike. The breakdown should be accompanied by high volume. RSI Divergence. If RSI is also showing weakness, it adds more confirmation. Bearish RSI Divergence occurs when the price makes a higher high, forming the head, but the RSI makes a lower high instead of following the price. What it means: even though the price is making new highs, momentum is weakening, signaling that a reversal may be coming. If you see RSI divergence forming along with a head and shoulders pattern, it's a strong indication that the trend reversal is real. Retest of neckline. As we saw in this case, a successful retest rejection strengthens the trade signal. If you found this video helpful, hit the like button, subscribe to Trade Junction, and turn on notifications so you don't miss future trade breakdowns. See you in the next video, and as always, trade smart, stay disciplined, and keep winning.